It's time now for our currency report. Got to take a look at the U.S. buck, considering the U.S. Federal Reserve came out with its rate decision just 46 minutes ago, 2 p.m. Eastern time, and you can see that the trade-weighted buck did move higher. Now, there wasn't a change in the bank's rate. We weren't expecting one from the Fed. Still on track for a December hike, and they're talking about staying on that gradual move upwards. So let's take a look. The U.S. dollar, that would be, maybe a session high following that rate decision. Let's talk about that and a few other things we'd expect from the Fed and the U.S. economy. Adam Button, Chief Currency Analyst at Forex Live, joins us in studio. Good to see you, Adam.
Hi, Greg.
So let's start with the Fed. Not a lot of surprises there, but the market seems to take it as a strong indication, looking at the swaps as well, that we're getting that hike in December.
Yeah, it's up around 80% still. And the market was a little bit worried that the Fed might downgrade things. We've had this turbulence in markets, and there was some thinking that the Fed might want to just tap the brakes just a little bit. In the statement, it was virtually identical. They only changed one little line to say that business investment has moderated from a strong pace from saying it was strong. Everything else is strong employment, strong wages, strong really across the board. So they're enthusiastic about the U.S. economy, and the U.S. dollar has responded, but just moderately.
When I think of some of the commentary that we were hearing after the midterms and the fact that the Democrats took the House, now we have a split Congress, and that they would keep Mr. Trump perhaps a little more reined in, and that would have implications for the Fed. But that's the job of pundits and analysts. The U.S. Federal Reserve, along with other central bankers, they usually let things play out to see what actually happens. So it would have been surprising, I guess, if there had been change of tone just because of the midterms.
Yeah, I mean, it's really, there's so much talk about politics, really, in every market in the world. It's one of those things that's easy to talk to, it's written about, and it's really the fundamentals that are moving the markets, but we talk endlessly about politics. And that creates this fear, uncertainty, and just worry about what's going to happen, and that weighed on the market. And almost with every election, it's the same playbook, whereas once it's over, the sun comes up in the morning, you know, nothing's really changed that much, and nothing is really going to change that much, and you've seen markets respond.
Now, one idea was the fact that if Mr. Trump was reined in a little bit longer term, we're talking into 2019, they won't be able to get as aggressive as they have been in terms of their agenda and any more aggressive tax cuts. So perhaps there, the Fed wouldn't be in a rush. It wouldn't change the course that they're on now. It just wouldn't put them into a more aggressive course.
Yeah, I mean, the Fed, it's tough for the Fed and it's tough for us because you have these political promises, right? And, you know, could they have really done a 10% middle-class tax cut? You know, the market probably gave that a 5 or 10% chance. Now it's probably closer to 1 or 2%, but there's still a chance. I mean, Democrats probably don't want to vote against a tax cut. It's very tough to run on that. So, you know, there are ways to stimulate the economy via infrastructure, via other things, via working together. And what we're looking for now is some indication that they will work together, or if they'll be extremely antagonistic. And that might be the next real move in the markets if it's driven by politics. Whereas the Fed, you know, it's a really steady pace right now, but the market is unsure whether it's going to be one more hike next year. I mean, we're going to get one in December, pardon me. And then one more hike next year, or as many as 4 more next year. And there's a pretty wide divergence there, and it's almost time for the Fed to start clearing that up.
I want to talk about, obviously, the big live issue that we do have, apart from what happened in the midterms, the relationship between the United States and China, and how that plays out and what it could mean for the currency trade.
I mean, I think if we look back on 2018, years from now, it will be the year that the relationship changed between the United States and China. I mean, we're all wearing poppies right now, and we talk about, you know, you look at these wars and how easy it was to get people whipped up. You know, 10 million people died. 25 years later, we have another war. 20 million soldiers died, and they signed up for this, most of them. And, you know, we've seen this rhetoric now in the U.S. change towards hostility to China. You know, China hasn't changed. You know, from there, and they really haven't changed. In America now, we have to ask, in the big picture, do they want China to just change a little bit? You know, loosen up things on IP, technology transfers, work with the U.S., narrow the trade deficit? Or do they want to curb China more broadly? Do they want an economic battle? Do they want to contain China politically, economically, and into some kind of Cold War scenario? And I think now, like, the genie is out of the bottle. And we can very easily fall over the tipping point to where China is just an American punching bag for the next 10 or 20 years. And that has great implications for markets, for growth. And I think that's the way to look at it for the year ahead.
All right, Adam, always a pleasure to have you here.
Thanks, Greg.
Adam Button, Chief Currency Analyst at Forex Live.